This Reddit user asks, how to avoid index fund bubble? Further elaborating with, index fund investing has been the holy grail of stock investing since its inception. It has been working well for everybody, however, it could become a bubble, as some experts pointed out. When there are many and constant passive buy pressures regardless of the price, the stocks in the index have lost the ability to price discover. This leads to bubble/overvalue. If you look at the PE ratio of companies in the S&P 500, they're all way higher than the historical norm. And yes, indeed, many finance and investing experts have pointed out and said that we may be in an index fund bubble because so many investors are now using index funds, and index funds operate without regard to the underlying fundamentals of the stock and the price of the stock. They just invest the money, the capital that comes into the fund, at market cap weighting. So if there's a company in there that is taking up a substantial portion of the index by market cap, because it is overvalued, the index funds subsequently are investing more into it as it gets bigger, and that's just creating a cycle where it's already being valued without regard to its underlying fundamentals, a specific stock, and the index funds are just contributing more capital to it, propelling it upward. Now, it's all in theory. We don't know if this is indeed a problem. Some other, counterpoints to this have been that, well, this is all in theory and that there really can't be an index fund bubble because of the efficient market hypothesis. Okay, so keep in mind this is all theoretically speaking. Now, personally speaking, I am not a big proponent of index fund investing. I like to operate on the basis of investments based on fundamentals in companies, not index funds, which operate without regard to those fundamentals, as I've already said. So in this video here, I'm going to cover some strategies or investment methodologies that would avoid an index fund bubble, or are likely to avoid, I should say, because again, this is all theoretical. The other thing I should point out here too is the poster mentions if you look at the PE ratios of companies in the S&P 500, they're all way higher than historical norm. That is the case generally speaking. I haven't looked at price to earnings ratio or the CAPE ratio, cyclically adjusted price to earnings ratio, of the markets in a while, and I probably should have done that before I started recording this video, but I do know that generally speaking, over the last few years, like 5 years at least, they've been higher than historical norms. But while that's not nice to look at, right, and we don't like to invest when things are high, on one hand, there's no rule that says we can't be entering a period where things are sustainably higher going forward. So keep that in mind. Now, let's talk about and let's get into ways that you could invest if you want to avoid an index fund bubble. And we'll start by looking at a chart here of the S&P 500 through a very bubbly time, starting back on 12/31/89 all the way through the end of 2009. And we can see right here through the 90s and up into the early 2000s is the dot-com bubble. And at this point, everyone was trying to invest in tech and internet stocks, which had really just came onto the radar of everybody. And people were just investing into them like a game of hot potato, right? Trying to invest, ride the wave up, and sell it before it tanked. We saw the same thing happen too around the COVID bubble, but it was really pronounced and really dramatic here in the 2000s. Investors were operating and investing completely without regard to price or underlying fundamentals of the business. In this case, they weren't using index funds, though. They were just investing directly in the stock. Index funds were not as readily available or known about at this time, but this is a prime example of a bubble, and the bubble burst here in the stock valuations, and we had the dot-com crisis in the early to mid 2000s. Now, also on this chart here is the Great Financial Crisis, but I really don't lump this into the category of a bubble. Yes, housing was in a bubble, but stocks really, in my opinion, were not in a bubble. The Great Financial Crisis really came about as a result of weakness in the underlying systems and lending institutions in the banking system, not so much that stocks were just completely overvalued. The bubble here is really in the 2000s. All right, my screen recording software cut out there, so I had to restart it. I'm not exactly sure where I'm starting from, but follow along. We're going to start here from equal weighting as the first method of diversification, really, away from index fund market cap investing. And right here, I found a chart of the S&P 500 equal weighted versus market cap weighted being in orange, and equal weighted being in blue, going back to 1990. And this simply takes all of the holdings in the S&P 500 and weights them equally, because in a market cap weighted index fund or market cap weighted system, the top 50 stocks in the index, and mind you, that's only 50 of 500, the top 10% of the stocks are holding nearly 50% or more of the value, right? So it's very, very concentrated, and this gets you exposure in equal weights to all of the companies in the S&P 500, and subsequently it's not susceptible to companies that just get valued up and then bought into by the index funds. Because if we were to look at the market cap weighting of the S&P 500 today, it's probably like 7% Microsoft, 7% Apple, 7% Nvidia, right? It's going to be a lot concentrated in those companies. So by equal weighting them, we avoid the companies that are really becoming a disproportionate amount of the index. And going back to 1990 through, what does this look like? The middle of 2023, June 2023, equal weighting has outperformed market cap weighting by a long shot. But I want to focus here on this time period that we were looking at in the chart, that 20-year period from 12/31/89 to 12/31/09. And what we can see is through the dot-com bubble, the market cap weighted index really just rip-roared above. I know it doesn't look like it in this chart because of how it's based, but in reality, it rip-roared above the equal weighted variant of the index here. But when the drawdown came, the equal weighted S&P 500 didn't sustain much drawdown. And then later on through the 2000s, it continued to hum along and really outperform the market cap weighted S&P 500. And that's where this chart gets a lot of its outperformance from. I believe that if we were to put the equal weighted S&P 500 on a chart with market cap weighted from about 2010 going forward, market cap weighted would outperform. But through the lost decade of the 2000s, it really performed very, very well and did indeed avoid the bubble. But that comes at the expense of missing some of the upside. And for some investors, that might be perfectly fine. I think I really fall into that camp. I would rather trade a few percentages of return on the upside for a little bit of protection or less downside. So if we put the equal weighted S&P 500 ETF on here, we don't have data back to 2000 like this chart is, so it may not be on it. Here it is. Okay. So the equal weighted S&P 500 came out in 03. We'll just set this to 04. There we go. And we'll just go to current day. We can see they've actually performed about the same. I was not so much expecting that. Maybe, again, if we set this to 2010, the market cap weighted variant would have really outperformed, but they've done about the same. And as you see from the chart here on this page, there's the same chart, but this page, during the bubbles, the equal weighting tends to avoid bubbles. So that is one way that we could avoid an index fund bubble. Let's go on from there. The second thing we could do is value investing. And right here for the last 3 years, I've got Vanguard's US Value Index Fund on here, VIVAX, with the S&P 500 on a total return basis, started at $10,000. We can see for the last 3 years, they've performed about the same, with the Value Index Fund performing slightly better than the market cap weighted through 2022 and 2023, where market cap was just humming along, not really doing so well when the liquidity pools dried up as interest rates were rising. If we set that back to the 5-year, oops, doesn't show it. Let's refresh. I've had that tab open for a few minutes before recording. Let's go 5-year VIF, VFINX. Right there, if we go through the 5-year, we can see, however, value is not kept up with the market cap weighting. But again, in periods like the lost decade of the 2000s, value will outperform, or we would expect it. We can't say it will because we don't know what'll happen. Going forward, there's always going to be unique things happening in the financial markets. But through the 2000s, actually, was I even saying that right? Yeah, market cap weighting outperformed there. Let's just go back. All right. 1231.09, 1231.99 to 1231.09. We can see value did indeed slightly outperform market cap weighting. Interestingly, though, equal weighting outperformed both of them. There are multiple value funds out there. VIVAX, Vanguard's US Value Fund, is pretty broad speaking. You could get into something narrow that really dives into the highest, I believe, quintile, it's got to be quintile, about of stocks. Actually, I think it's even deeper than that. Maybe decile of stocks, something like QVAL, Quantitative Value by Alpha Architect, something like that. But if you're interested in avoiding bubbles, the premise to know here and start your basis for research is value investing is one option. Moving on from that, there are blue chip / quality funds, okay? One that has been pretty popular in recent years is this one by Distillate, and they explain it here as they invest in quality and value companies, stable cash flow, low leverage, with normalized high cash flow yields. And it's interesting. Let's just look at the holdings here and see which ones are up there. United Health Group, T-Mobile, Johnson & Johnson, AbbVie. And so, yeah, this is one option. These companies are likely not going to be susceptible to frenzy buying that is creating bubbles. As some alternatives to this, there is a blue chip growth ETF. There's probably a non-growth blue chip ETF, which would be another option. There is the cows ETF, which is an interesting one that invests in companies by cash flow yield. So it's investing in companies that have high cash flow yield, spitting off a lot of cash. Which is different than profitability, I should say, because companies can distort the profitability. It is not as easy to distort a metric of free cash flow yield like what cows seeks to invest in. Now, this other fund over here mentioned cash flow. And what I think is important to point out here is that they look at high normalized cash yield. So what I've seen in my research here of cows is that they're not looking so much at a normalized number, because this cows ETF is perpetually chasing the high yield. So when there are little, so to say, cyclicalities in specific sectors, namely energy, we saw this play out, this ETF can cycle into a lot of energy stocks because they're just churning out cash real quick. But then the market for them, and this also applies to like natural gas and oil, the market for them kind of dries up and then they all go bankrupt and they're not spitting off cash anymore. The natural gas, oil, energy sector, speaking broadly, is very susceptible to these boom and bust, and cows does tend to pick it up, although, over time, it does perform very well, or we have seen it perform very well. If we look back at the last 5 years here, we can put cows on here. And we can put, what's the other one? DSTL on there. And we can see how well they have performed. Actually, both of them performing quite well. If we look here at the COVID dip period, we can see the blue line representing the DSTL ETF did not have nearly the drawdown that cows did. Cows had a major substantial drawdown, a little bust, and then a boom back up, and it's done very well over this 5-year period. But if we look at it over the last 1 year, what are we going to see? Well, cows has done quite well. I don't think anybody's going to be complaining about their 25% return, but the S&P 500 market cap weighted has definitely outperformed that. And that's the trade-off again. If you want to avoid bubbles and have returns when things are stagnant or going sideways, you're going to not participate in such the upside. And finally here, there's one other option of investment out there. Mind you, there's probably others that I'm not covering. These are just 4 primary types. And that is quantitative trend following, like the Pacer Trend Pilot. And this one looks at the pattern of the 200-day simple moving average. I'm not going to go into detail on it because, quite frankly, I don't remember, but I have looked at this ETF extensively and I have studied trend following based on moving averages, and I do have a substantial portion invested in a strategy based on trend following, not the Pacer Trend Pilot, but absent giving a whole substantial lesson on trend following and quantitative metrics, I will say that these Trend Pilot ETFs are fairly well put together, and they're also well established with significant AUM, but they move in and out of the market. So if the market starts turning downward, like in an 08-09 type of thing, or a dot-com bubble, or even to a lesser extent in COVID, they move out, move to T-bills, and then when the market starts trending upward by quantitative metrics, specifically in this case the simple moving average, they get back into the market. Now, let's just put one of these on the chart here. We'll put it on against the S&P 500 for the last 5 years, and we'll use PTLC, which is Pacer Trend Pilot Large Cap. Basically, it's applying their strategy to US large cap. They do have global variance, and we can see how it's performed. It has not performed nearly as well as the S&P 500 has, market cap weighted. And while right here during the COVID dip, it certainly did not do, I shouldn't say it didn't do what it should. It did exactly what it was supposed to do, technically speaking, but it didn't save it. Where these trend following strategies and ETFs really buckle is under periods of high volatility. So if we were to look at the 2000s, and let's see if I have that open on the chart here. I don't have it open, but we'll just go back to it. Here we go. During periods like the 2000s, when the peaks and troughs were fairly rounded out and not so sudden and not so volatile, trend following looks great. But their weakness is, the Achilles heel, is periods like the COVID crisis here in March, April of 2020, when things just take a dive out of nowhere and go down. Trend following does not do very well. And in this case, it went down, it went out, and it lagged getting back into the market and catching the upside. So again, you're missing out on the upside potential, but you're saving the downside, or you're protecting the downside. You're trading upside potential for downside protection here. And over the last 5 years, it hasn't done bad, but at the same time, when you're looking at the market cap weighted indexes just rip-roaring up here in 2021, you're feeling pretty left out in a trend following strategy. And then let's just look at it from 2022 onward, when things got a little sideways, we should say. Right here, yeah, the trend following looks pretty good, saved you from some of the downside and volatility here. And then it gets back into the market and keeps going up. Those are some good trend following products out there that put trend following in the hands of everybody without actually understanding all the quantitative metrics behind it. So yeah, guys, my take on it is, personally speaking, I do think that there may be some index fund bubblishness going on, and I really don't like investing on that. I do like equal weighting. I like all the things I covered here, but I like equal weighting. I like investing on fundamentals, and I do like investing in trend following. But that said, statistically speaking, mathematically speaking, our highest chances of, or not our highest chance of performance, but our best performance is likely to come from market cap weighting. So you may be in a scenario where you want to allocate a little bit away from market cap weighting to one of the options I discussed in the video. On that note, guys, I hope you found this video helpful and insightful. If you do, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off.